did you had mentors as well where they helped you grow as a fund manager?
I definitely had mentors. I still do. But I think like when you're on your first fund, you kind of need people on fund 3 to give you advice because people who are on fund 8, they just don't remember fund 1 for the most part. And they probably started it 20 or 25 years ago and a lot's changed. As you get later, you kind of need different people. Like now, a lot of the people I go to for advice are people who've hired and developed a lot of GPs. And so I think the job of a fund manager is to constantly seek out people who are 1 or 2 steps ahead of you.
Today we had Charles Hudson on the pod. Charles is the managing partner and founder of Precursor Ventures, an early stage venture capital firm focused on investing in the first institutional round of financing for the most promising software and hardware companies. He's one of the pioneers of pre-seed investing. He's also an advisor and mentor to a number of emerging fund managers. We covered founding story of Precursor Ventures, fund strategy and evolution of Precursor, concentrated versus diversified portfolio, which one is better, why having a differentiated strategy is important for fund managers to succeed, strategies for fundraising from LPs successfully, how to handle rejections from LPs, the hardest part about building Precursor, the value of mentorship in venture capital, his favorite piece of advice for emerging fund managers, who is he outside of work, and much more. Now I bring you Charles. Charles, so good to have you on the pod finally.
I'm so glad to be here. Thank you so much for having me.
Yeah, and then we were just discussing that I've been a creep. I've been following your content. I've been following you on LinkedIn, Twitter, and I got to learn a lot. So really appreciate you for putting that content up.
My pleasure. It's been fun to get back into writing this last year.
So, Charles, maybe a good starting point would be, what got you into angel investing, and what was the founding story of Precursor Ventures?
Yeah, well, it's funny. My angel investing business, which predates my VC career, actually started because I ran a conference business that was focused on digital goods. And I kept meeting all these really interesting founders, some of whom spoke at my conference, some of whom didn't. A few of them asked me to be advisors, and I ended up being an advisor for a few of those companies. And one of them turned out to be super successful and was acquired by PayPal for quite a bit of money. And I was like, this angel investing thing is great. You put in a little bit of time and money and you get a really great return. Excuse me. And then subsequently, I realized that there's one big downside to angel investing if you're not already independently wealthy, is you will run out of your own money at some point. And so I realized pretty quickly I liked angel investing. And the thing I liked about it most was the opportunity to bet on people and to really be in the business of like people picking. I just thought that was like a really fun experience. Fast forward, around 2010, I was spending some time with Jeff Clavier, who was the founding and managing partner at Uncork Capital. And I ended up joining him as his first partner. And I worked at Uncork for about 5 years. And the one thing that I really took away from my 5 years there was, I think as a team, we were pretty good at identifying the next generation of great founders and finding them early before they had product market fit, before they had a ton of traction. I think we did a pretty good job at that. But that fundamentally, at least in my view, is a small dollar strategy. It works better when you're writing 250, maybe even 500K checks. It doesn't work well if you have a big fund and you're trying to deploy capital $1 million to $1.5 million at a time. It just simply doesn't work. And so my big aha was, I like this work of like betting on people, finding them early, giving them that sort of capital to go from idea to launch product with some evidence of product market fit. But to do that, it's hard to do that if you're also trying to balance that with doing super talented repeat founders who want to raise $5 million rounds because they sold their last company to Google. And so I said, I just want to have a dedicated fund that focuses on a really specific founder profile. It's people who are generally outside of the networks that make it easy to raise capital and people who don't have traction. Because my whole theory is, the venture capital business is pretty efficient at getting money to people who are in Y Combinator or went to Stanford Business School or worked at Stripe. Like we've pretty much solved that problem by and large. And I think a lot of venture funds will give money to someone that they don't know, who's got traction or has a launch product or something you can touch and feel. But I think most venture capitalists don't wake up every day thinking, how do I go invest in a company started by people that I don't know that well, who don't have any traction? And I wouldn't say we're the only firm that does that work, but we're one of a pretty small club. And I just said, if we can get really good at underwriting people before they have data, before they have product market fit, I think we could build a really interesting business at Precursor. So that's what we've been doing for the last 9 years.
Got it, Charles. So you did touch upon, the fund strategy, but maybe let's elaborate a bit more. What has been, or let's put it this way, what was your fund strategy in the beginning, and has it evolved over the years?
I would say I'd like to think we're still largely doing what I set out to do, which is backing people from sort of day one. Our first fund was $15 million, and we did 83 companies out of that fund. Our fourth fund, which is our most recent fund, was 85 million, and it was like 100 companies. So the basic structure of what we do hasn't changed. It's by most people's standards, a lot of companies per fund. I quite enjoy investing in a large number of people. I think it's really fun. I think that's how you find great teams. The big difference is we used to write 150K checks, and most companies needed 500K to $1 million to go from pre-seed to seed. Now we write 500 to 600K checks, and most of our portfolio companies need like $5 to $7 million to get to Series A. And so our fund has grown, as you can see, like the size of the portfolio hasn't grown that much, but the fund's a lot larger. And that's because my experience has been our companies simply need more capital to clear the bar for subsequent rounds. And because we're meeting them in this little fragile moment when they're first getting started, I felt pretty strongly that we should be able to provide that capital that they need. We can't really rely on the goodwill or kindness or support of other people. Like, this is something we have to be able to solve for ourselves.
Got it. I would assume it seems like, you already had access to these companies, you were investing, and then you were helping these companies fill up the round. And then the subsequent rounds, you're like, hey, can I help them close the round even faster and get even more ownership? And Charles, it's interesting that, your portfolio size had stays the same. It's anywhere between, let's say, 70 to 100. And there's a very healthy debate around, highly concentrated or concentrated versus diversified. What made you pick, the diversified portfolio, and how do you convince your LPs that this is the winning strategy?
Well, as the person who feels like he's on the losing side of this debate, I would say most LPs I pitch are firmly in the concentration strategy. And I understand why. It's a lot easier to mull a spreadsheet that's 30 companies where one of them ends up being special and you own 10% of it and life is good. I think that works well with companies that are like relatively de-risked. I think if you're in the business of backing people at the idea stage, I don't think you have to make more investments, but I think it's easy to argue why you should, which is that like we invest in almost every category of investment. Mine is kind of deep tech, hard tech, or biology. We don't really do those things. I'm really trying to pick the very best founders, regardless of what technology area they've decided to work on. And like a Y Combinator or like someone else who works with a large portfolio of companies, I think this model works really well. And it's not spray and pray. For me, it's just the companies we back need money and some of our time. Not as much time as our LPs think. Actually, the money is a big unlock for the good ones. It allows them to go off and hire and scale and do the things they simply can't do without money. And I would argue that like if you have the chance to buy 5 to 10% of really great companies started from scratch by people that you think are amazing, I'm much more of the Naval school where you should do all the ones that are above the line. And so my view is that like there's nothing magical about 80 or 100 companies. It's not like I wake up every year and say, we must do 40 companies, not 39, not 41. We must do 40. No, I meet thousands of companies a year. We keep a really high bar. And the ones that clear that bar where I think the people are special, we invest. And if I look back, our very best investments were all kind of strange companies. At the moment we invested them, people kind of scratched their head and they turned out to be great. And we had some companies that started out kind of as head scratchers and remained head scratchers. So I believe at our stage of investing, it works. I wouldn't do it at Series A because at Series A, like you need to be on the board, you need to be more involved. The check sizes are larger. For us, the governance is relatively light. And the problem statement is simple, which is go from no product to a product with product market fit in 12 to 24 months on $1 million or less. That's the assignment.
Got it. And you recently, wrote a blog around non-consensus being right. Maybe let's double click on that.
In addition to running Precursor, I'm on the investment committee for Screen Door Partners, which is a fund of funds that invest in the next generation of fund managers. And I do a little bit of LP investing on my own. And so I meet a bunch of people who are like, oh, we're focused on being non-consensus and right. And they'll show me their fund pitch, and 75% of the pitch is on their non-consensus part. And I always tell them, like, well, the key part of non-consensus and right is actually, like, being right is the name of the game. And I've met some people who I think are contrarian for contrarian's sake, or have picked small niche areas that they can dominate that I don't think are actually big enough to produce fund returning companies. And so a lot of what I do when I'm thinking about investing in someone else's fund is I just ask them this really simple question, like, given your strategy, why are the very best founders in your ecosystem going to choose you? And the people I find who have a clear answer as to why they're going to get chosen and where I agree with them, I generally invest in those funds. There are other funds I meet where the person's answer, I just don't find it that compelling. And so I'm always encouraging people, yes, you need to have a differentiated strategy. Like when I started, investing in people that didn't have connections to the VC ecosystem and didn't have product was a radical idea. Not that many people thought that was a good way to make money 9 years ago. Most people said, this is the opposite. You should go find all of the people you really know and have worked with before at great companies who have traction and give them as much money. I'm like, but like that's already dominated by established firms are very good at finding those people. It's pretty tough to Sequoia or Andreessen or Greylock to a consensus, obviously good founder. They've been getting to know those people for years before they even start a company. The people we go after are just not on most people's radar screen. They're not a population that's being like actively cultivated. And so I didn't do this out of any sense of being contrarian. I was like, I just think there's an opportunity here that other people don't understand. And it's more that like other people don't understand it than it's intentionally contrarian. And I just worry that I've met a bunch of fund managers who like the contrarian nature of their belief system is like a big part of their fund pitch. But I'm just like, it's definitely contrarian. I just don't think it's going to work.
Got it. And Charles, now shifting gears to fundraising. And, as you said, you had set out to do things that were against the norms, which is, hey, I want to back companies at the earliest stages. And I want to back folks who doesn't have the connections in the ecosystem, who don't have that pedigree and all that. How was the fundraising journey for you? Starting with Fund 1, and then also what were the learnings over the period of time, and what were the shift or strategies you took and that helped you raise capital?
Fund 1 was really hard. It's really hard. We raised all of $15 million for our first fund. It took about 2 years, hundreds of LP meetings. And, I think like a lot of fund managers, you prepare for the questions that you think you're going to get. Then you go pitch your fund and you learn that the questions you prepared for are maybe not the most important thing. So Precursor has always been a solo GP fund. I've always been the only partner. And I spent a lot of my time preparing for people to ask me questions about your solo GP, when are you going to bring in a partner, how you think. I was probably over prepared for that conversation, at least in my mind. I felt over prepared. I had not spent enough time realizing just how controversial our portfolio construction was going to be in the eyes of LPs. It just to me seemed obvious that if you're doing from scratch companies, doing 60 or 80 or even 100 of them per fund isn't radical. That's what a lot of the now established concentrated seed funds, they started off their life making more like 50, 60, 70 investments per fund. Famously, SV Angel does a deal a week. And so I was like, there are plenty of examples of people who've done this before and succeeded. Boy, did I run into a wall of resistance with LPs. They were just like, this doesn't work. You're not going to own enough of your winner. There's a litany of reasons they told me like it won't work. And I dramatically underestimated how radical the idea of one person making 80 or 100 investments per fund was for these LPs. And I made one really important decision, which is like, I believe this is the right thing to do for our fund. And so instead of being wishy-washy about our plans, I tried that. It didn't work. Being like, well, maybe they'll find a partner and maybe we'll get more content. It's terrible. I was like, nope, this is what we do. I believe in it deeply. I think it works. If you sign up to trust me with your capital, you're going to get more of the current product. So if you do not like this current product, and I totally understand if you don't, you should not invest in our fund because you are going to get more of this. If by chance you do like this model, you should invest in as much as you can in our fund because you're also going to get more of this. And my promise to you is that if you invest in our fund, you're going to get more of this. So you've got to decide, is like this thing that we've built and that's on offer, is it something that you really want? And I just felt like once I got to the clarity that like, this is what we're doing, it won't be for everybody, but for the people who like it, it should be really interesting and it should be a really great fit. That's kind of where I landed. And it's been incredibly clarifying for me. And I think it's been probably the single biggest improvement we've made in our fundraise, is to just be really clear about like, this is what we do, is what we believe in. I think it works. I put like a lot of my personal money and time behind the idea that this thesis works. And I get it. Not everybody sees the world through the same lens.
Got it. So stick to who you are and stick to your strength. Charles, are there any, you've learned, sure, a lot of lessons hard way as well. What's the best way? There are no best ways, but let's pick few.
Mhm.
How to go about fundraising? Let's start from scratch. Pick a number. This is how much I want to raise, and that aligns to your fund strategy. How to go about sourcing LPs, building relationships, and closing LPs. And on the last part is you wrote a very interesting blog around how to take no's. There's so many fund managers these days, they're raising and it's a hard environment to raise. What's the, maybe elaborate on that as well.
Boy, one of the best pieces of fundraising advice, I've gotten a lot of really good fundraising advice. I think I'm better because people help me see things I couldn't see myself. And one of the best pieces of advice I got, it wasn't stated this way, but this was my takeaway, which is like, you should continue to spend time with people who are trying to get to a yes. And what I mean by that is I have LPs who said no to me on our first 3 funds and came in on the 4th fund. And I think sometimes people just say, you should continue to build relationships with VCs. And I was like, there are people I met in fund 1 who are like, I just don't like what you're doing. Like it gets at odds with our belief system for what works in venture. And I went back to that person for the 2nd fund. They're like, yet again, this does not align with our belief system about what works in venture. And finally, I was like, this person is not trying to get to a yes on Precursor. This person is very comfortable in their assessment of our fund. And why would I continue to subject myself? There's enough rejection on the fundraising trail as is. There's no reason to sign up for that kind of repeated rejection from someone who's been very clear that what you're doing is just like not of interest. And so I said, all right, so maybe I could make my life better by doing a couple things. One is, let's just respect people who've decided that our model doesn't work for them. And instead of trying to convince them that they're wrong, and instead of trying to continually show up, like, listen, if we get a clue that they've changed their mind, we should pounce. But like, otherwise, like, leave those people alone. Just let them be. Everything's not for everybody. Second, for the people who are trying to get to a yes, invest the time in trying to help them get over whatever hesitation they might have. And like, I don't think we've ever convinced anybody that Precursor is a good idea, but I would say we've certainly helped people get past their own objections, if that makes sense. It's a subtle difference, but those people, I think, were looking for a way to get to a yes, and I think we helped them. The other thing is, with this getting to know, I have some LPs that I absolutely adore and love. They are not an LP in my fund, and they never will be. But they've done so many things to be helpful to me, and I honestly think our relationship blossomed when I stopped asking them for money. They just took that off the table. And I think what I tell founders sometimes, whether you're starting a venture fund or you're starting a company, whenever there's an ask on the table, whether it's implicit or explicit, I think it creates a shadow around the conversation that you have to navigate. And like, once that's gone, it's just 2 people hanging out, spending time together. And so I'm really grateful that there's some really talented LPs who've given me honest feedback and advice. They've made intros for me. Like, they've done like tons of, and like, I don't ever ask them to invest in my fund, and I never will. And I think like our relationship really blossomed. So I will say this, every GP I know has a slightly different mix of LPs. And what I found is like, I kind of eventually figured out the profile of people who like Precursor. And I like spend a lot of time trying to get in front of those people. And there's another profile of people who generally don't like our fund. I will give all of those people a first shot, a meeting or 2, but if it doesn't resonate, it doesn't resonate.
Got it. And Charles, you've been building for the last 9 years. What's been the hardest part for you about building Precursor? In general, what's the hardest part about building a venture?
I think the answer to this is, for me, very simple. The hardest part of building a venture firm is the firm building itself. It's not the investing. And I think what I've learned is, only 25% of our current team is focused on the investing side of our business. So 75% of the people at Precursor work on things that are in support of running the firm. That could be finance, that could be investor relations, and that could be the team that helps me handle all the things that are on my plate. But there's only 3 or 4 people at the firm. Primary job is to go out and find companies to invest in and support those companies. It's a really small group of people. And I think when I talk to most emerging managers, their enthusiasm is for the investing side of the business. And I get it. That's the fun part. But, Form ADV and franchise tax board and and payroll and like running the firm is a lot of work. And the longer I do this, the more complicated management of the firm becomes. And if you're not careful, you can end up in a world where if it's not your design to do so, you end up managing a firm not being an investor. And I've been really clear with my LPs, like my goal is to have the majority of my time spent on finding new investments and supporting the investments that we've made. And that has meant that I've had to hire a much bigger team than I ever could have envisioned to handle all of the non-investing tasks that happen at our firm. And when I'm talking to new fund managers, I spend a lot of time talking to them about the non-investing side of the business and how they're thinking about it and whether they're prepared to spend the time, money, and resources to get that done well. Like I just spend most of I assume their investment strategy, they've thought about it, and no matter what it is, I probably won't talk them out of it anyway if I disagree. But it really is like acknowledging that part of your job as a fund manager is to build a firm, is a good steward of your LP's capital, and gets them their statements and reports and all the things that they need on time, and like operates with a high degree of professionalism. And that's not easy. We're still working on it. We're not done by any stretch. We're still working on it.
Guy, interesting you picked up this point. I had Neil Mehta of ENIAC on the pod, and he talked about the same point where it's hard to build a venture firm, which is hiring the right kind of. That's where a lot of the venture firms struggle. And Charles, over the years, for you, or let's put it this way, whether it's a company, whether it's a product, eventually they improve and end up becoming something else. When you started, you've improved over the years, and that's the goal as a fund manager. How have you improved over the years? Also, were there, now you're giving back, you've been spending a lot of time with emerging fund managers. Did you had mentors as well where they helped you grow as a fund manager?
I definitely had mentors. I still do. I think what I've learned is there's a set of problems you have in Fund 1 where actually people on Fund 3, like people like Nahal, have been very helpful to me. But I think like when you're on your first fund, you kind of need people on Fund 3 to give you advice, because people who are on Fund 8, they just don't remember Fund 1 for the most part. And they probably started it 20 or 25 years ago, and a lot has changed. The person who's on Fund 3 probably still remembers Fund 1 and is a contemporary. As you get later, you kind of need different people. Like now, a lot of the people I go to for advice are people who've hired and developed a lot of GPs. And that's primarily managing director, managing partner level people at big multi-stage funds who've had successes and failures hiring and developing investor talent. Because like that's like the big top of mind issue for me today. 2 years ago, it was, how do you build a finance function in a venture firm? How do I go from doing this myself with my fund admin team to hiring a CFO? Do I need a controller? And like that was my problem 2 years ago. It's not a problem anymore. And so I think the job of a fund manager is to constantly seek out people who are 1 or 2 steps ahead of you and can answer the new set of questions that you have. So that's on the like firm manager side. On the investing side, I think the tension I have now is, we've made over 400 investments. It would be very easy to say we've made 400 investments. There are new rules at Precursor. We're never going to do X, Y, and Z thing because the last 3 times we did it, it didn't work out. I think once you start trying to get very rules driven like that, you can get into a lot of trouble as an early stage investor. So what I try to do is like always recapture the magic and wonder I had when I did our first fund, where I literally just didn't know as much, but we made great decisions. And I sometimes think that in venture, like too much experience is a curse because you think you've seen everything. And I have to remind myself all the time, you might have seen something similar, but it wasn't this team. It wasn't this time. It wasn't this, like there are things that are materially different, even if the situation seems quite similar to you. So I actually work really hard to make sure that like we're always looking at things with a beginner's mind to the extent we can as a firm. But I also think you should use your data to figure out like, well, what are you good at doing? Like we've done a bunch of analysis here, which has convinced me we are actually better at making first investment decisions than we are at follow-ons. We're good at both, but our initial underwriting decisions are very good, which has caused me to push the firm to have on balance a lot more dollars than our peers allocated to first checks relative to follow-ons.
Got it. And Charles, now as you mentioned, you do spend time with emerging fund managers, and you also run solo GP happy hours. How did it all started, and what's the goal of solo GP happy hour?
Yeah, I was actually hanging out in San Francisco with one of my other friends who runs a single GP firm, and we were having a beer, and he's like, "This sucks." I was like, "I know." I was like, "It does kind of suck, but we chose this life." And he's just like, "It's so good to talk to you because when I talk to my friends in multi GP partnerships, it's just not the same." And I was like, "You know what? You're right. We should have our own little club." And so I just posted on LinkedIn. I'm like, "Hey, I'm just gonna have a solo GP happy hour are. If you're a solo GP and you want to come by and have a beer and talk to your peers about awesome or not awesome about solo GP life, come on by. The first one we had like 25 people. The last one we had like 45 people. And then someone said, you should do this in New York. I was like, no, you should do it in New York. I don't like this isn't about me. Like, if you want to do this, like, you have the blueprint, like, just go run with it. Like, do a solo GP happy hour in New York. Like, you don't need me. So I just appreciate that when I got started, there were a bunch of people who were starting at the same time, some solo like Kent Goldman, others who were in small partnerships like Chris Howard and the ENIAC guys. And it was just nice to me to have a community of people that were all going through something similar at the same time. And I was just like, solo GP is a really unique experience. And I just hope we can remain a good community of people that are welcoming and supportive of the new people who come in.
I can totally relate with that.
Figured.
If I'm in SF, I would have loved to join. Charles, what's your favorite piece of advice that you give to emerging fund managers? And follow on to that is, what types of investors have succeeded over the years that you've seen? What characteristics that they've had?
The number one piece of advice I give emerging managers is like, just make sure you don't build something you hate. And I mean something really specific. A lot of people I meet get in the investing business because they like investing. If you keep your fund relatively small and simple, you have a lot of time to be an investor. If you decide you want to go raise a whole bunch of AUM and build a big partnership, you should just know that like, you probably won't do as much investing. You will do more firm and fund management. And so like, if you really like the investing side of the job, don't build a firm that's going to pull you away from that. And I've just seen a bunch of people that I know when we've hung out have been like, I'm not having as much fun. I spend more time on like HR and people issues and fundraising and all of these other things. And I'm like, well, that was kind of predictable based on your AUM journey and goals for fund size. And I've worked really hard to like make sure Precursor is an absolutely fun place for me to work almost every day. I have hard days, but I was like, I want to build a firm where I'm excited to come to work every day because I get to spend my time on the stuff that I'm excited about. And I tell people like, just be intentional about it. Otherwise you might end up inadvertently creating something that you're not excited about, and that would be a shame.
Got it. And Charles, with this, we will shift gears. My co-pilot wants to jump in, and he's asking, Charles, outside of work, what are you most obsessed about these days?
Boy, I spend a lot of time with my son. He's a lot of fun. I would probably say, I know this is going to sound funny. I am a huge Chelsea fan, and I have a bunch of Chelsea football fans in my life, and we spend a lot of time commiserating about the current state of Chelsea football. I also am really into coffee, and I am part of a group chat with people who are even way more intense about coffee than I am. And those are probably the two like highlights of my day, is like being a part of those group chats, because they're light and they're fun and they're things I care about that are not startups and venture capital.
Got it. And what's a typical day for Charles? Starting from waking up to going to bed.
I normally get up around 5:30 or 6. I spend a little bit of time with my son. I get ready. I come to the office. I'm usually here by 7. I'm usually here in the office, basically on Zoom or in meetings the entire day till about 6. Then I usually go home. I see my family till about, I'll work again from till 10, maybe 10:30, depending how much energy I have and importance of what's coming down the pipeline. And then I'll go to bed usually around 11 or so. Do that Monday through Friday. It's pretty simple.
And then how are you sleeping? How's the health coming along?
I need to get back on my exercise routine. It's okay. It needs to be better. My sleep is about as good as it's going to get right now. I've made it a priority, but I could still do better.
And Charles, hypothetically, let's for the time being, let's say you're not doing what you're doing and you have enough resources, time, I'm not sure, but you have time, not sure enough, but what would you work on? So
I teach an entrepreneurship class at the Stanford Business School, and I really enjoy teaching. It's a lot of work. It takes a lot of time and energy to be, and I have like deep respect for people who are good in the classroom. It is not easy. It takes a lot of prep, and I'm still focused on improving the quality of my teaching. I have a lot of room to improve. I enjoy it. I would do more teaching. I teach one quarter a year. I would probably teach another quarter if I could. That, and I really enjoy cooking. I would probably take a whole lot of cooking classes.
How do you like Indian cuisine?
I love Indian food. Great.
Yeah.
Great.
And Charles, we know you as a tech investor. What do your friends know you for? Who are you outside of work?
That's a really good question. A lot of my friends are people I've known since undergrad. So we've known each other since we were 18, and they're just like, he's a big nerd. And so we've known each other for so long. And then I have people that I know just professionally. I hope they would say he's like a nice, honest, warm person who like cares about his friends and his family and cares about the founders that he's backed. My life's pretty simple. I spend a lot of time with my family and I spend a lot of time at work and some time with my friends. And that's probably the whole pie. There isn't a lot outside of those three things.
Yeah. And if you could invite three people, dead or alive, to dinner, who would they be and why?
I think I'd pick President Obama because I think he's had just an interesting life. I think I'd pick Martin Luther King just because I think he had a short life, but an interesting life. And then, I was obsessed with the Iliad in high school. So I'd probably get Achilles just to like spend time with somebody who was like, I could probably think of 10 other people. Those are the ones that like kind of immediately come to mind for me. And I'd love to talk to someone who's actually been to space.
Yeah.
So maybe like Mae Jemison or Sally Ride or something. Someone who's like been to space.
Okay. And then what kind of what cuisine food that would be?
I think we would probably do like some kind of like seafood pasta thing, probably. Knowing me.
Charles, thank you so much. Thank you so much for coming on the pod and really sharing your journey and learnings with others. Really appreciate you for doing that.
Thank you so much. This was a great interview. I really enjoyed it.